Hey folks, Andrew Bernstein here, Cherry Blossom Capital. Just thought I'd go over a few quick things that I focus on. Fridays are very important days for trading. Right now it's about 5 a.m. I get up pretty early to look at the markets. Cool thing about currency markets is they are open 24 hours a day, 5.5 days a week. And they open Sunday evening Eastern Standard Time at 5 p.m. And they stay open until Friday afternoon at 5 p.m. They're closed Friday evening, Saturday evening, reopen Sunday. And I like it because you can trade all different sessions. There's the US session, then we go over, actually, it starts Asian session first. So, like on Sunday night, when it's 5 p.m. Eastern Standard Time, it's actually Monday morning in Asia and Australia. So, they're the first to open. They have their trading day while we're sleeping. And then US markets, or no, I'm sorry, European markets, and then we get US markets. And some of the most active are US markets, but you could trade all sorts of, different currencies such as Japanese yen, a very active pair. I love trading that. Australian dollar, Chinese yuan, obviously US dollars, euros, pounds. So that's why I like currencies versus stocks. Stocks are just, it's just daily from 9:30 a.m. to 4 p.m. That's it. So if you're a trading junkie like me, I like to trade all all the time. I love looking at markets. It's really my passion. Anyways, I mentioned that Fridays are very important days. So here's a cool website, MyFXBook. It's just got a trading calendar. So it'll tell you, hang on a second, let me figure out how to get back in the screen here. I think this is it. Here we go. Okay. Now, so in my FX book, it shows you where we are in the session. So right now, New York is sleeping. London, we're in the middle of the London session. So as you see, it'll move this way as time goes on. So we had Australia open first, Tokyo open second, London open third, then the New York session. And so technically, the New York session opens around, I think, 8 a.m. Eastern Standard Time. Even though it's really open 24/5, you could buy currencies around the clock. So you're not prohibited to those specific hours. Anyways, so we have that I wanted to show you. Secondly, I wanted to show you calendar. It's very important to stay on top of news because certain news events can just rock currency markets. Stock markets move, but not nearly as much as Forex. Um, so if you have some sort of interest rate surprise, I mean, you could see a massive move that could blow your account or make you a ton of money really quickly. So you'll see about 8:30 right now. This says 9:20. This is, I think, obviously ahead a little bit, but my clock says 5:21 a.m. This is a server that I'm on right now. So, anyways, you'll see at 8:30 a.m. personal income, core PCE. This is the inflation gauge. Every Friday, 8:30 a.m. they have very important information, news that's released. So you should watch Bloomberg or CNBC or something to watch the news at 8:30 and understand what's happening, especially Fridays. Thursdays and Fridays are very important. You could lose or make a lot of money. Hopefully, you all make a lot of money. But I just want to show you another quick thing here. We've got a trade I put on with y'all the other day, US dollar, Canadian dollar. It's on the dailies, so I'm going to zoom out. If you recall, I showed you guys how to draw an Andrews pitchfork. Okay, 3 points. And then statistically, there's a high probability of price heading towards the median line. And so I put this trade on 2 days ago, right about here. So what I was looking at, I found price was going up, and then came down to this lower median line and found support. Came up again, broke through, closed below. Here's one day, opened the next day, came up, had some resistance right there at the bottom of the median line, closed below, opened the next day, closed above the median line right here. Came down below again, closed the next day below, and then came up here, closed above, and right here what I'm looking at, why this intrigued me, is because I read the market to try and understand what the institutional traders are doing. Because this is all institutional money. This is the hedge funds moving these. And sovereign wealth funds, I mean, entire countries, they trade currencies to, to offset any differences in their currencies. So anyway, so what I saw here was buyers coming in. All right. I see support here. And if price goes up when a buyer buys, boom, it means there's buyers here. And every time price goes up, we get a little floor here and we going up, up, and then we close above here. And to me, this is a good spot to get in, to go long, because your downside risk is minimal. I like to put my stop just below the last level of support here. Trying to look for another tool here. So anyways, you can see if you draw a line here and look left, you see support in this region here. So here's price. So you're at like 1.373, right? That's where buyers are, clearly, So why not put a trade on and see where it goes? Mitigate your downside with a stop. Always trade with a stop loss. Never ever trade naked or you will lose your money. Promise you. And then our profit target up here is 6.5 to 1 trade. So our win is potentially $65. I just put on a small position, 0.01 lots. And our downside is a max of a $10 loss here. And I'm just going to sit back and watch, And I don't get too excited about moves like this. I mean, it's nice that we had this pop here. But if you look to the left, we've got previous highs where there were sellers. So if you look back to the right now, we're going to run into that point of resistance. And we need to watch what happens. Because price is going to do what it wants to do. There is no set or guaranteed direction that price is going to travel in. We make educated bets like this that based upon history, there's an 80% probability, but nothing's guaranteed. If y'all hear somebody saying, I guarantee X return, or I guarantee this is going to happen, run far, far away. There are no guarantees in finance, and you can lose your money. There's high risk associated with this, so please be careful. All right, I just wanted to show you this, and then secondly, it's kind of looking at the market, trying to find another good opportunity. I think I did. So this is the British pound US dollar daily. All right. Now at face value, you look at this chart, it doesn't look too exciting, right? So I'm going to just show you guys really quickly let's see, I'm going to put a pitchfork in here. Here's pitchfork. Sorry, I got a little distracted. What intrigued me here, we got a high, and then we have a lower high here. So if you were to run, let's go to weekly, it'll be easier. All right, oops, messed up here. There we go. Do our weekly chart, zoom in a little bit, and we go from high, low, high. Let's draw a pitchfork right here, see what happens. Boom. All right. Now looking at this, it's a very intriguing setup to me. All right. So price previously, now remember, each bar is a week, 1 week. Okay. Sunday night it opens, moves, Friday closes, Sunday night it opens, Friday closes. So each one is 1 week. Now we're going up, boom, we get slammed back down. We find support down here, buyers step in these weeks here, price goes up, breaks the previous high, makes a new high, right? And then we come down here, and the previous high was right here. Okay, see this line? So price came down, came back up to this previous high, broke through here. All right, let's put that line right there for a minute. All right, now price is traveling along this line. So the question is, are buyers going to remain active pushing this up, or has there been a change in sentiment? And are these buyers that were pushing this price up here, buying, buy, are they going to become sellers? Now, statistically speaking, we've got a median line here that looks like it's being respected. You see that? So we had to push through, but it didn't close outside of this median line. See, price came up, boom, and then came back down during that week and closed right here below this upper median line. And then sellers took control this week, pushed the pound down, and the US dollar rose. So what I am seeing is a change in sentiment that sellers are starting to take control. And based upon our history of median lines, there's an 80% probability that price will travel to the center median line. So again, I'm going to put another little trade with y'all. All right. Let me turn this sound down. I don't know what it is. Might be a little loud when I put these trades on. Sorry about that. Lower volume right here. All right, so we just sold 0.01 lots, which is $1,000 at 1.33580. And that's, we just sold the British pound, expecting the pound to drop and the dollar to rise. My stop loss, I want my stop loss just outside of this median line, okay? So we always trade with a stop loss, remember? Never ever trade without one. 1.3647. Oops, left side. All right, there's our stop loss now. I'm going to drop this down a bit. It's going to risk $20 on this one, okay? See that on the left side here? Over here, you see the price, or the max loss I can sustain. Now what we're going to do is come down here to the median line and put our take profit, 1.252. Boom. Let's see what our max gain might be here, or win. So let's line it up. 1.25. That's going to give us $85. So we're risking $20 to make $85. Now that's just with 0.01 lots, right? See that? You can, the cool thing about Forex is there's pretty much an unlimited amount of lots you can trade. The big funds out there are trading 100 lots per trade. I mean, you do the math. I mean, they're deploying billions, tens of billions of dollars in one purchase or one long position or short position. So, and then when a central bank lowers or raises interest rates, it just like opens the floodgates and prices move really, really fast. I want to show y'all one more thing here about the US dollar, Swiss franc. They used to be pegged so they'd move together. Go to the daily chart. I used to trade at this time. I like a different kind of look here. All right. Here's the US dollar, Swiss franc. Back during 2011, you look here. There was a move so violent and so sudden that tons of different brokerages, traders went bankrupt instantaneously. I'm trying to remember which move it was. Might have been right here. I think that's it right here. So it was 2015. It was overnight. So everybody in the United States was sleeping. And the Swiss central bank unpegged, I think it was, the US dollar from the Swiss franc, or unpegged the Swiss franc from the US dollar. And price of the Swiss franc. So this is US dollar, Swiss franc. So when this goes down, that means the dollar dropped and the Swiss franc rose. So almost instantaneously at this point, when they announced that, boom, price just plummeted. And it happened so fast, like literally in seconds. These moves can be so fast, so violent, that your account will be blown in a second. They now have safeguards in most Forex brokerages. In the US regulated brokerages, I think there's only 3 or 4 in the US that are regulated right now that are available to trade on. They put in some like loss mitigation, I guess, thresholds where if your account drops to $0, it'll automatically close all of your positions. So you cannot lose more than the money in your account. Before this instance, you could. And some brokerages, I mean, you could rack up $100,000 like loss in seconds. So imagine that. How scary would that be? Anyways, just something to check out. We've got British pound, US dollar here. We'll watch and see where it goes. But this is Andrew's Pitchfork. I'll have some new videos coming out soon about breakout trading, about moving average cross trading, about all these indicators here. I'll teach you all about these oscillators. So I'm sure you've heard of relative strength, stochastics, Bollinger Bands, moving averages. I'll teach you about standard deviation, parabolic SAR, all different very cool methods of kind of looking at the market. The secret is that nobody will tell you is you can make money trading with pretty much any one of these strategies. It's not as easy as just like, hey, you know, this moving average crosses that moving average, let's buy or sell, because you'll lose money. It's about finding the optimal parameters of any indicator. And a way we do that is through optimization. If you look down here, this is called a genetic algorithm I have running. And a genetic algorithm utilizes all this computer's memory to run through all the possible parameters that we set for a specific strategy. So if we're going to buy when a moving average it crosses over another moving average, what moving average should you use? 1, 2, 10? How about on the long one? Should you use 20, 25, 55, 200? Because most are going to lose money, but you need to find the specific look back period for that moving average to work with the other moving average. Anyways, that's about it for now. 8:30. Check out the markets. We'll see where it goes. I think it's gonna be a wild day. Big data coming out. One quick thing, lastly, before I forget. So British pound, US dollar we got here. Okay. And then we've got US dollar, Canadian dollar. Let's follow this one. It's a little clearer. See, it's moving. Now when the US dollar, so US dollar, Canadian dollar, when this goes up, that means the dollar is rising. And when the dollar is rising, you need to understand correlations between markets. How are markets correlated? Okay. So let's just look at this. Trading economics. All right. So we've got all of our different asset classes here, different securities, commodities like oil, gold, silver. The global indexes, S&P 500, NASDAQ, Japanese 225, the Nikkei. You've got all these here, right? Shanghai, Chinese index. we've got individual stocks, we've got Forex, crypto, so Bitcoin and others, and bonds, right? Now, correlations are what moves when something else moves. So let's just take commodities. Let's take gold. Gold, for instance, is typically a hedge for the stock exchange. So theoretically, historically, not always, it was inversely correlated. So when stocks went up, um, gold would go down, and when gold would go up, stocks would go down. It was a hedge. That's not the case anymore because gold has been on a tear. Some things have changed in the markets and correlations change. But when you look at Forex, all right, typically, not always, when the dollar goes up, US stock markets go down. So if this is correct, and this is US dollar, Canadian dollar. When this goes up, we're expecting US dollar to rise, Canadian dollar to fall. Okay? If this were to come to fruition, there's a high probability that markets will drop. Okay? So, like I said, it's not 100% of the time. High probability. I can't give you an exact probability because I don't know. But if history plays out, we may be looking at a significant drop in S&P 500 and the QQQ and a significant rise in the US dollar. And the US dollar is a safe haven currency, which means when there's increased geopolitical tensions with Russia, whatever, some wars going on, economic instability like we're seeing, we're starting to see unemployment rise pretty dramatically under President Trump. It's going to continue going up, and we'll see where it goes. But I personally think we're going into recession. I think these tariffs are a terrible idea, and it's just causing consumers to struggle. Middle and lower income families are getting crushed right now with inflation. The price just going to the grocery store eats up most of their paycheck, and it's just a terrible situation across the board. Consumer spending is being driven 100% by the highest net worth families in America. Bottom line, it's fact. Middle and lower income families are struggling. And it's going to get worse, in my opinion, because what I am seeing, if, this 80% probability holds up and the dollar pops, stock market's going to drop quite rapidly and quite a bit, maybe 20%. But I hope I'm wrong. I don't want anybody to lose money. It would be a good buying opportunity, though. So if you're a long-term investor, be like Warren Buffett. Warren Buffett keeps 25 to 30% of his company, Berkshire Hathaway, one of the largest companies on the planet, in cash because he hopes for those big drops. Warren Buffett is a value investor. He does not like paying top dollar for companies when their prices are up here. He likes big drops in companies and he buys down here, just like we're doing with the US dollar right here. So, anyways, have some cash on hand in case there is a big drop. Mitigates your downside risk because you'll buy S&P 500 at a much lower price, and then 10 years from now, you'll triple or quadruple your money. Anyways, hope you enjoyed. Take care.